Let's be honest, market volatility feels like financial whiplash. One day you're up, the next you're questioning every investment decision you've ever made. But what if I told you that some of the greatest fortunes are built not in calm, but in chaos? Peter Lynch, one of the most successful investors of all time, didn't just survive market crashes, he thrived through them. While most investors panic and sell when the market dips, Lynch looked for hidden gems. He saw bear markets not as threats, but as shopping sprees. His approach wasn't about predicting the future. It was about understanding the present. In a world obsessed with quick wins, he bet on solid businesses, patience, and deep knowledge. And that mindset turned millions into billions. So if you've ever felt lost during a market correction, you're not alone. But the good news? You don't need a crystal ball, just a strategy. In this guide, we'll break down how Peter Lynch approached investing, why long-term thinking wins, and how you can use these lessons to navigate financial storms and come out stronger. Ready to think differently? If you really want to start transforming your financial life, the key is to keep it simple. No need to complicate things. I've left a link in the first pinned comment below. Click there and find out how to take your first step. Believe me, you'll be rewarded with everything you need to achieve success. When most people hear bear market, they panic. But Peter Lynch, he saw it as a clearance sale at his favorite store. Instead of running away, he dove into the chaos, hunting for quality growth stocks that others were too scared to touch. He believed that market downturns were opportunities in disguise, especially for those who had done their homework. And let's be honest, nothing tests your patience in investing quite like a sea of red tickers. Lynch didn't just preach optimism, he practiced it. One of his boldest moves came during the 1987 crash, when panic was the norm, and headlines screamed disaster. While others fled the financial markets, he stayed calm, analyzing corporate profits and long-term returns instead of daily noise. He often reminded investors that stock market history shows recoveries usually follow crashes. Timing the bottom, impossible. But being ready for the rebound, that's strategy. His legendary Magellan Fund thrived not because he predicted market corrections, but because he embraced them. Rather than fearing volatility, he used it as a tool, identifying undervalued gems amid the chaos. He didn't let investing mistakes from others scare him. He saw them as learning material. Want to invest like Lynch? Start by flipping your mindset. Bear markets aren't threats. They're invitations to think long-term. It might sound bold, but history and math are on your side. Over the past decades, the stock market has delivered long-term returns that often double investors' money every 10 years or so. This doesn't happen by magic. It's fueled by real growth, corporate profits rising, innovation booming, and economies expanding. Sure, market corrections and crashes come and go, but so does winter. Spring always follows. Peter Lynch emphasized looking beyond the panic and focusing on fundamentals. When volatility hits, most people focus on fear, but seasoned investors ask, are companies still making money? Are they innovating? When corporate profits trend upward, it's only a matter of time before stock prices follow. Even during a bear market, those profits quietly build a foundation for future rallies. Patience in investing pays off literally. Think of it like planting a tree. You don't yank it out every time the weather changes. You water it, trust the process, and wait. The same goes for growth stocks. They might dip with market downturns. But over time, their roots, profits, and value dig deeper. If you stay in the game and keep learning from stock market history, doubling your investment in a decade isn't a dream, it's a smart expectation. Volatility can feel like riding a roller coaster blindfolded. One day, you're up, the next, you're screaming into a pillow. But Peter Lynch often said, "The real key to making money in stocks is not to get scared out of them." When the financial markets get choppy, patience isn't just a virtue, it's a superpower. It separates long-term winners from impulsive sellers. Let's be real, no one enjoys seeing their portfolio dip, but reacting emotionally to short-term noise often leads to investing mistakes. Instead of trying to dodge every twist and turn, Lynch advised focusing on what matters: business fundamentals, not market mood swings. Even during major market downturns, staying invested has historically beaten trying to time the exit and re-entry. Think less day trader, more gardener. Polaroid and Kaiser Industries are case studies in what happens when you lack patience or follow hype. Chasing flashy stocks without understanding the business leads to regret. But if you choose wisely and hold tight, time becomes your ally. Stock market volatility might rattle you in the moment, but the long-term view brings clarity. Patience in investing isn't passive, it's intentional resilience. Peter Lynch loved finding hidden gems, but he also knew how to spot fool's gold. Two classic examples he often cited were Polaroid and Kaiser Industries. At their peaks, both were market darlings with soaring prices and flashy headlines. But beneath the hype, the fundamentals didn't justify the valuations. That's the danger with overvalued stocks. They look shiny until reality hits. Polaroid had revolutionary technology, but its earnings couldn't keep up with its stock price. Investors bought the hype, ignoring that profits weren't growing fast enough to support the valuation. Lynch pointed out that when expectations become unrealistic, it's a setup for disappointment. Kaiser Industries followed a similar path. Its parts were worth less than the sum investors were paying. The stock market history is full of these warning signs. Learning from these stories means digging deeper. Don't just ask, "Is this popular?" Ask, "Is this profitable? Sustainable?" Growth stocks should grow in value because the business grows, not just because the crowd's excited. Market corrections often hit overvalued stocks the hardest. So before jumping on the next hot pick, pause, research, and remember, price is what you pay, but value is what you get. When markets tank, panic becomes contagious. Everywhere you look, headlines, social media, even friends, someone is screaming, "Sell!" But here's the thing, selling during a market downturn is like abandoning your seatbelt during turbulence. You're reacting to fear, not facts. Peter Lynch believed that some of the best opportunities are born in times of chaos, not comfort. The stock market history shows a consistent pattern after every crash. There's a recovery. And those who held on rather than jumping ship reaped the rewards. Bear market investing isn't about being fearless, it's about being informed. If you own solid companies with growing corporate profits, selling low just locks in losses. Volatility is temporary, but regret can last much longer. Instead of running from the storm, try walking through it with a raincoat of patience. Market corrections can shake your confidence, but they also shake out the weak hands. Remember, Peter Lynch turned 18 million into 14 billion by staying in the game, not timing every dip. So next time the market drops, ask yourself, am I investing in noise or in value? At the end of the day, stocks are more than just symbols and tickers. They represent real businesses. And real businesses are driven by one thing: profits. Peter Lynch hammered this point home again and again. If a company consistently grows its corporate profits, the stock tends to follow. It's not magic, just math. Over time, earnings growth drives long-term returns. That's why Lynch didn't obsess over stock prices in isolation. He focused on what was happening inside the business. Is it selling more? Improving margins? Expanding wisely? When profits rise year after year, the stock market eventually catches up even if the price lags for a while. This is the kind of insight that turns market volatility into opportunity, not fear. Too often, investors chase hype instead of performance. But in the long run, flashy headlines can't cover up weak earnings. Financial markets reward companies that deliver real value. So if you're looking for stocks to hold for years, follow the money, not the buzz. Because while markets rise and fall, a company with strong, steady profits is built to last. Turning 18 million into 14 billion isn't. Luck, it's discipline, vision, and a whole lot of research. Peter Lynch didn't try to outsmart the market with wild guesses. He dug into company reports, visited factories, talked to managers. He believed the stock market was full of chances for ordinary people who were willing to do a little extra homework. And that made all the difference. Lynch famously said, "Know what you own, and know why you own it." He wasn't chasing the latest hype or trying to time market crashes. Instead, he trusted in the power of long-term returns and the resilience of solid businesses even during downturns. His success wasn't about avoiding mistakes, but learning from them. Like when he misjudged Polaroid, then adjusted his strategy accordingly. The magic came from combining patience in investing with common sense. He didn't just invest in numbers, he invested in stories, in potential, in companies that made things people actually used. From growth stocks to overlooked gems, Lynch proved that anyone could thrive in financial markets with the right mindset. And if he could do it, what's stopping you? Now that you've uncovered Peter Lynch's secrets to investing like a pro, the question is, how will you apply these lessons to your own portfolio? Remember, the key to success is patience and discipline, even when the market feels uncertain. It's not about getting every move right, but building a solid foundation and staying strong through the ups and downs. The takeaway here is clear market volatility doesn't have to be a threat, it can be an opportunity. Are you ready to start looking beyond the uncertainty and focus on companies with real potential? Ask yourself, what's the next step in your financial journey? The time to act is now. Don't wait for the perfect moment that may never come. If you want to keep learning how to invest smartly and confidently, make sure to subscribe to the channel and turn on notifications. Together, we'll dive deeper into how to thrive in the markets and achieve your financial goals. See you in the next video.